Hello everyone. This video is about psychology of trading, entering the mindset. So when it comes to psychology of trading, it's not necessarily about taking full control of yourself emotionally. It's not all about that. It's about being able to visibly see where the market is flowing. You have to be willing to, unless you want to take your quick trades on NASDAQ or gold and whatnot, there's still weekly setups and monthly setups for other traders that are more for the long-term trade. Because in technicality, the longer you hold the trade for, if it goes in the proper direction, the bigger you can profitize on that trade. So, that being said, it's how do you disattach yourself from your money? How do you unattach yourself from any emotion towards money on itself? Because you have to put money down to make more money, which is the unfortunate truth about life. Now, if you're able to flow within the market itself, is how you profitize the best. So, in a way, the best things to go for typically would probably be around 3 to 4 days of holding your position. Now, there are parts of trades that it can end up going in the opposite direction, but everything is based off of probability. So when you go off probability, you're able to determine better on which direction that it's actually going to flow. Now, for your best setups, you have to go from the smaller keyframes to the bigger keyframes and see how it's gonna start matching up with what direction you want to go, whether it's you're buying a long or whether you're buying or you're selling of the position. Now, when you buy, if you don't know about buying or sell positions, buy is when you determine the position to go up, and sell is when you determine the position to go down, and you make the money off of it. That being said, also, using leverage. Greediness is a big factor that ruins traders. Greediness is when you're not able to accept when you've entered something well and you could have pressed sell, but you're starting to see it go in the opposite direction of your trade, and you're like, oh no, it's going to go back. It's going to go further. And the thing is, if you sold at that point right there, the truth of the matter is that's where you would have made your best profits, because now it's going in the opposite direction and you are seeing the dollar symbols shrink, or see the dollar symbol shrink. Yeah, it's very important to zoom out. Zoom out, look at 4-hour time frames, 12-hour time frames, 6 hours, all of them. And if you should also wait, given the chance that there is a consolidation phase for a few days. During those days is more for your scalping trading, not your longer hold term tradings. So your best bet is when you start to see it consolidate, after it either goes this direction here, boom, 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 and then just stays steady within a certain amount of price area for a couple days. Yeah, you want to get out of that after it goes close to the level that you would have initially had it at for the sell point of your long or your short position. So in the opposite direction, you know what I mean? It's boom, 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 consolidation, through that area. And it could be a huge consolidation zone. Like, you don't know until you know, you know. So it's really important. Again, I keep mentioning the keyframes because that's where you determine where you enter. So even patience is going to be your best friend. Not being emotionally attached to your money is also going to be a big factor when it comes to this. Because let's say you run your account from 1,000 to 10,000 in just a week, and you end up thinking, oh, well, if I did 1,000 to 10,000 in a week, I'm gonna make 100,000. I'm gonna make up to 100,000 now in the same week. No, you're not. No, you're not. Although it is highly possible, depending on what you trade on, what charts you look at, and whatnot, how much leverage you use without, being stop loss or stopped out from the position, taking over half your money that you already had in the position, or taking all of it. Especially if you do cross trading, you can take the amount that's already there from your first trade, and like as it's gathering profits, take that exact amount and put it on another one, and it adds up the amounts and adds up. So you can get like stopped out horribly in any sense. But you also have to be willing to lose the money that you're going to be putting down. You have, like, in a way, if you're going to truly train yourself, you have to be willing to lose thousands of dollars. I say thousands because you're going to win thousands too. Most trades are not going to go in the direction you want at first. And remember that keyword, the key two words, at first, because you need to be patient and find your entry. There are points of liquidity sweeps that are important to watch out for, because when you have liquidity sweeps, that's when you have your giant wick that'll either go and then come back down quickly, but you see the giant wick versus that little candle part right there. Like, that's a huge liquidity sweep, whether it's in the up direction or down direction. Either way, that usually determines if you have, like, if you wait after that and check and see how it bounces, like if you have two confirmations, like a W shape, bum, 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 usually that's a good indication that it might be going the upward direction now. But you also have to wait sort of for a third confirmation in which it pushes past that resistance level and ends up becoming a support area. So like shooting up through the area, boom, boom, it becomes support on top of the original W shape. So it would be up here where that original W was. After that is when you would enter and then go up. Or same thing, opposite direction, just flip it. But yeah, so those are what I would believe to be helpful tips on the psychology of trading, because smart money as well is always finding a way to manipulate the market, because they know that whales or, average regular day traders are going to be losing money, and it's going to be fueling their pockets because they can and will manipulate the market in certain directions, so also that their shareholders can make a certain amount of percentages as well. So there is a lot. So if you're able to put yourself through the worst and still push forward, then you definitely deserve that right to be the day trader. You deserve, everything you've ever wished for if it stems from day trading, because you haven't given up yet. Day trading is most definitely not giving up. So only you can make the money you make for yourself. So why not put away money that you're not able to be attached to in a way you don't need it, and you're not going to use it? Save up, buy a prop firm account, and then go from there. I love y'all. This was Psychology, Entering the Mindset of the Trader. I hope all of you have a great night. Like and subscribe. Peace.